All right, everyone, let's talk about that little book that apparently beats the market. It's a short read, only about 150 pages, so you can finish it in one day if you really wanted to. But I'm going to go over and share my review of this book and the investing strategy. First, let's talk about why beat the market in the first place. So the stock market, as referred to as the S&P 500, is a basket of the 500 largest publicly traded companies in the US. And that broad index on average has returned around 10% per year. And that's before inflation and taxes, of course. Now, that's not a bad return. If we invest $1,000 in the S&P 500, we double our money every 7 years. Now, if you're able to beat the market and say get a 15% rate of return, we double our money in every 5 years. And if we somehow manage to get a rate of return of over 20% per year consistently, we double our investment in every 3.5 years. So you see, the temptation to beat the market is really high on Wall Street. In fact, so much so that we've got a whole industry built around trying to beat the market. But very few people have actually done it. And Warren Buffett is one of them. You may have heard of him or seen him. He has consistently beaten the market in the last 58 years and counting by doubling the return of the S&P 500 and clocking in at just under 20% returns per year. Simply put, had you invested $1,000 in the S&P 500 back in 1965, you would have close to $238,000 today. That's not a bad investment for $1,000. But had you invested with Warren Buffett, that same $1,000 would have turned into over $35.5 million. And that's the power of both beating the market and compounding over several decades. But you see, the key isn't to just beat the market. The key is consistency. You and I can beat the market maybe 1 year or 2 years in a row, but can we do it over and over and over again? Can we do it for 58 years? That's the tricky part. And that's where this book comes in, because it's literally titled That Little Book That Beats the Market. So Joel Greenblatt, who is the author of this book, also ran Gotham Capital, a firm which has beaten the market over the last several years, returning just over 30% per year. Again, that's an incredible return. He shares his secret on how we can do it as well. Now, the first thing that Joel talks about is market volatility. During his teachings at an Ivy League school, Joel talks about how stock prices can move wildly in a given year. They can go up and down and all over the place. And in technical terms, we call this a 52-week high and low price. And that is indeed true, because a company like Apple can trade at $120 per share today, then in a few months trade at $180 per share, and then trade back down to $100 per share in 1 year. And that's just one example. We see this happen in the market every single day. We see stock prices and company valuations fluctuate billions of dollars, not to mention hundreds of billions of dollars. And that is the volatile nature of the market. So Joel asks a very simple question to his students. How is this possible? How is it possible for the stock price and the company's valuation to swing so wildly up and down or back and forth? Are these companies making twice as much money, or are they doing something dramatically different? Are they making twice as much profit? What's going on? So Joel answers this in one simple sentence. He says, who knows and who cares? Maybe people go nuts. But a more thoughtful answer is, it's hard to predict the future. With companies, we are constantly trying to predict their future sales, their future earnings. Sometimes investors feel optimistic about the company's future and price is high. And other times, maybe not so much. Investors are pessimistic and the price is low. Sometimes it's hard to decide and expectations change throughout the year. Now, Joel also goes on by saying that the truth is that I don't really need to know why people are willing to buy and sell at such different prices during a short period of time. I just need to know that they do. And Joel also talks about Benjamin Graham, who, by the way, is the father of value investing. He also wrote the most popular book, The Intelligent Investor, and also mentored Warren Buffett. And Joel talks about how the market gives us 3 options every single day. We can buy, we can sell, or we can choose to do nothing. Some days the markets are generous and the prices are trading at much higher than their true value. On those days, we can think about selling. Some days, maybe not so much. The markets are very pessimistic and the prices are trading way below their actual true value. On those days, we can think about buying. And on other days, the markets are very fair. prices are trading exactly where they should, and they are very much in line with the true value of the business. On those days, we can choose to do nothing. The author states that we are never required to act. We alone decide when the price is right. Whether it's too low or too high depends on our assumption of the true value of the stock. Now, while the market may have these wild swings in the short term, Joel also says that over the long term, the market will always get it right. In other words, in the short term, the market prices can swing wildly up and down, but over the long term, facts and reality take over, and prices usually trade where they're supposed to. Now, this also reminds me of the popular quote from Warren Buffett where he says the markets in the short term are a voting machine, and over the long term, it's a weighing machine. This quote differentiates between the popularity of the stock in the short term versus actual value of the companies in the long term. Now, Joel also talks about margin of safety. Benjamin Graham referred to this practice of buying shares of a company below its true value as, quote, margin of safety. Something we also have talked about on our main money investing channel. Now, margin of safety is that extra layer of protection that we build for unforeseen events and catalysts that can really drive the stock to lower levels. For example, if I believe that Apple's true value per share is $120 per share, and I decide to buy Apple at, let's say, $100 per share, that $20 is my extra margin of safety. That protects me. That's the additional layer of protection for any unforeseen events. Now, this book talks about two financial metrics and states that once used effectively, this value investing strategy can beat investment professionals, beat the returns of top-notch professors, and even outperform every academic study that's ever been done, and in fact, double the annual returns of the S&P 500. Those are pretty bold claims, and one of the things that we have to understand is that this is a deep value investing strategy where the goal is to buy great businesses at great prices. The author says that as value investors, there are only two financial metrics that we need to focus on. The first one is earnings yield. And this is the first principle that the book teaches us. It's a way to measure our return based on the earnings. Now, earnings yield is very simple to calculate. You can take the earnings per share of a company, also known as the EPS, and divide that by the current stock price. So for example, if Apple has an earnings per share of $6 and it's trading at $160 per share, the earnings yield for Apple will be 3.75%. Now, we can compare this earnings yield with another investment alternative, such as the risk-free rate offered by the US government bond, which depending on when you're watching this video can obviously vary, but let's just say that it's at 4%. In that case, an investment in Apple stock yielding 3.75% earnings yield makes Apple a less favorable investment at this time. Now, the earnings yield can change based on both the price of the stock and the earnings per share of the company. Let's just go back to our example. If Apple's earnings per share was not $6, but instead $10 per share, now $10 divided by the current stock price of $160 yields a 6.25% return. Now, if the price was trading at a lower level, let's say $110, even better. The earnings yield jumps to over 9% per share. Now, this 9% is much better than the government bonds, so both EPS and price can change the earnings yield. The second metric that this book focuses on is the return on capital, and that's the second financial metric that this book teaches us. Now, Joel says that this is the secret to making big money in the markets. Return on capital is essentially a calculation which allows us to understand how efficient the business is. The formula to calculate the return on capital can vary, but in simple terms, it is simply net income divided by total capital. For example, if Apple had a net income of, let's say, $100 billion last year, and they have a capital of $200 billion on their balance sheet, then their return on capital is 50%, $100 billion divided by $200 billion. And that is a really, really good return on capital. And now we get to the magic formula. The magic formula is the formula that this book claims can significantly beat the market and all market participants at their own game. And so let's just have the drum roll, please. The magic formula is a combination of both the high earnings yield and the high return on capital, the two metrics that we just talked about. When we combine those two metrics together, we create the magic formula as mentioned in this book. When backtested this magic formula over a 17-year period from 1988 to 2004, owning a stock portfolio of 30 stocks, which were a combination of both the high return on capital and high earnings yield, returned approximately over 30% per year. A return which doubles our money every 2.3 years. That's a crazy return. Now, during those 17 years, the overall market averaged around 12.3% per year. So an $11,000 investment in the S&P 500 would have gained to an impressive $79,000. But an $11,000 investment in the magic formula would have yielded a return of over 30%, resulting in the portfolio value to grow to over $1 million. Now, Joel also states that the magic formula itself isn't the key secret of the success of the portfolio, but instead it is the belief in the magic formula. In other words, it's our understanding of why it works and trusting the process during the tough times that makes all the difference. And we'll talk more about this later in the video. To create the magic formula, Joel says that we need to start with a universe of public stocks of over 2,500 in the US exchanges. We create the first list, which includes the stocks with high return on capital. The higher the return on capital, the higher they rank on that list. We then create a second list, which ranks all these stocks based on their earnings yield. Again, the higher the earnings yield, the higher they are on that list. And now remember, the goal isn't to find the stock with the highest return on capital or the highest earnings yield, but instead, the magic formula is to find a stock with the best combination of the two metrics. We then combine these lists together, add up their rankings, and now when we look at the combined rankings, we select the top 30 stocks with the highest return on capital and the highest earnings yield. And during that 17 period, this magic formula also performed better on a risk-adjusted basis against the S&P 500 and also had a 100% win rate during any 3 consecutive year period during those 17 years. Now, at this point in the book, I don't know about you, but I was impressed and yet still very skeptical of this magic formula. Yes, it's worked in the past. Yes, it's outperformed the markets by a mile. Yes, the returns and the risk aversion has been very good. But I had 2 questions. Has this magic formula been back-tested at any other time periods? And the author shared one example of the 17-year time period between 1988 and 2004. In my opinion, this was very much cherry-picking the data. And the second question was, what about the future though? Will it continue to work when the whole market and the economic landscape changes with technology and AI? And I'll share my thoughts and conclusion towards the end of the video. Now, if you're wondering that if this magic formula is so great and beats the market, why isn't everyone using it? Why isn't everyone rich and outperforming the market? And that's because Joel says the secret sauce to this magic formula isn't the formula itself, but the belief in the system. As the author mentions, trusting the process is more important than the process itself. Now, Joel mentions that the magic formula does indeed underperform the markets in 5 out of every 12 months on an average in a given year. And the strategy can also continue to underperform for a few years. He says, the reason why everyone isn't using the magic formula is because it's not easy to continue with a strategy that hasn't performed well in some time. And that is so true because it's not easy to stick with a formula or a strategy when it hasn't worked out for several years. When things don't work out, a typical response is not like, I know this hasn't worked for a long time, or I know that I just lost a lot of money, let's just keep doing what we're doing. People just don't think that way. A more rational response would be like, well, we gave it a try, let's just move on to something better or something different. So what's the point? The point is that if the magic formula worked all the time, everyone would probably use it. And if everyone used the magic formula, it would probably stop working. Everyone would be buying great stocks, great businesses at bargain prices. And as the demand comes in, the prices would no longer be trading at lower prices. And in fact, they will push higher. Now, Joel says that investors have a very short time horizon. If we have to wait 3, 4, even 5 years before a strategy works, most investors won't or can't wait that long. And after a few years of underperformance, most investors look for a completely different fund or strategy. And this is so common on Wall Street, and it's also called style drift. Now, style drift happens when the fund diverges away from its style of asset management to chase returns. And it happens all the time on Wall Street. For example, if we have a fund that strictly focuses on investing in technology stocks, but tech is having a bad year and instead energy is having a great year, style drift would happen if we ditch our strategy of tech stocks and move into energy stocks to chase returns. And style drift happens all the time on Wall Street and between hedge funds and even professional money managers who believe that their strategy will work over the long term, have a hard time sticking with it after a few years of underperformance against the benchmark and also their clients leaving. And this is exactly why hedge funds have very short time horizons, as short as a few quarters, because they are trying to beat the index. Now, to further solidify our confidence in the magic formula, Joel explains that the formula is systematically helping us find above average companies trading at below average prices. I like that line a lot from that book, above average companies trading at below average prices. The author gives us a very simple example of a kid named Jason who runs a chewing gum store. By selling gum, let's assume that Jason is able to bring in $200,000 of profits for his business from just one store. Now, if he decides to distribute those profits to shareholders, that's fine, but the growth in that scenario will stagnate. Next year, we're still looking at $200,000 in profits. But if Jason decides to invest those profits back in the business and opens up a new gum store, a second gum store, and let's assume that the second new gum store generates $100,000 in profits in the first year. Now the business went from generating $200,000 in profits to $300,000 in profit between the two stores. That's a 50% increase. And that's the power of high return on capital. Now, of course, companies with a poor return on capital are not good because in our example, if the new gum store did not work out, let's say that it was in a bad location or the demand for chewing gums was falling, not only the new store would fail, but the original store number one would also decline because of the fall in demand. And that creates a low return on capital. Hence, the magic formula forces us to look for companies with high return on capital, companies that can invest capital back into their business and earn a high return. And Joel also talks about capitalism, and that's the idea that eventually someone will notice and see these high returns of capital and will enter their market. And if it is easy to compete, eventually competition will drive down the returns on capital to an average level. But despite the competition, it is possible to achieve a high return on capital. And this can be done due to brand positioning. It can be done through competitive advantages or even the product that the company is selling. And let's just face it, right? We're more likely to pay higher prices for Coca-Cola versus for something that's more generic, like a cola brand that we've never heard of. And so companies that can generate a high return on capital more likely have a special advantage of some kind that they can exploit. And that special advantage keeps competitors away from destroying the ability to generate above average profits over the long term. Now, the formula also only chooses companies with a high earnings yield, and that means we are getting a bargain for that stock because the price paid is low compared to the company's earnings. And the book also makes a case against picking individual stocks and mentions that if you absolutely must pick individual stocks, do it with caution. And research the companies well and apply the magic formula in one way or another to better enhance your analysis. If you're not going to put in the work or if you're not willing to put in the work, he says you have no business investing in individual stocks. Joel also mentions that a concentrated strategy of about 5 to 8 stocks is better than a diversified portfolio of 20 to 30 stocks. And the reason is simple. Having a deep understanding of 5 to 8 companies is a lot easier than having to analyze 30 or even 40 different companies, unless you are using the magic formula. In that case, we need at least 30 stocks is what Joel mentions because we need that law of averages. Meaning that just because a company has generated a high return on capital does not mean that it will happen forever. So we can't take a general average and apply it to an individual company, which is why we need to own at least 30 stocks in this magic formula investing strategy in order for this to work out and for us to get the benefit of the averages. Now, here's a step-by-step guide on how to use the magic formula for yourself. Now, for this magic formula to work, we need to follow these exact steps, Joel says. And the first step is that we need to own 20 to 30 stocks so that we can take advantage of the law of averages. Step number 2, we slowly buy into these companies, and the strategy recommends buying about 5 to 6 stocks over a span of few months until we get to that 30 stock threshold. Step number 3, we need to hold them for 1 year minimum. For losing stocks, this strategy recommends selling few days before the 1 year mark. And for winning stocks, this strategy recommends selling a few days after the 1 year mark. And my guess is that we're probably taking advantage of the tax loss harvesting and the long-term capital gains tax. Now, to find the stocks that rank highly on this magic formula list, we can use different stock screeners and plug in our different filters. But the book also has a website called magicformulainvesting.com where we can go and kind of pick a different threshold for market cap, and it spits out the 30 or 50 stocks that meet those combined criterias. Now, this strategy recommends that keeping that market cap threshold to about $50 to $100 million, but you can play around with that number however you see fit. And once we have a list of 30 companies, we then slowly and steadily buy into these companies over the course of 1 year, adding about 5 to 6 companies every few months. And finally, once we have established our 30 stock portfolio, we sell each of these close to the 1 year mark. Again, losing stocks a few days before the 1 year mark and winning stocks a few days after the year is over. And we repeat the whole process and replace all 30 stocks with the new ones or the same ones depending on the companies that the magic formula is recommending. Now, Joel also says to eliminate all financial and utility stocks, and my guess is that it's probably because they inherently trade at very low earnings multiples. So what may seem like a bargain may not necessarily be one. And finally, he recommends eliminating all foreign companies. And now we get to my thoughts on the book and this value investing strategy. So there's not a lot of exhaustive studies or back testing that's being done on this strategy, partly because it's so difficult to back test. We are rotating in and out of stocks every year, and it becomes difficult to identify companies who rank best or worst in a given year in the past. And for those reasons, there's been blogs that are suggesting that this strategy is still going strong and has been able to beat the S&P 500. Other blogs suggesting that this magic formula is also working well in international markets, in equities over in Europe, Asia, and even other parts of the world. And other studies suggesting that the magic formula has not worked in the last 5 years. So the data for and against this strategy is like all over the place. So in my opinion, this is a great book for anyone who is just getting started with investing. It is a very beginner-friendly, short book filled with lots of humor, and you can literally finish this in 1 day if you wanted to. But you're also better off just reading up on a summary or watching a review to get everything out of this book, because at the end of the day, we're only talking about this magic formula, which is a combination of 2 metrics, the high return on capital and the high earnings yield. And the strategy that this book focuses on is a deep value investing strategy. When I think about these 2 metrics as an investor myself, I understand the logic behind this and this methodology with a high return on capital. We're only going after quality companies with a high earnings yield. We're only buying them at supposedly bargain prices. But I would have preferred to see some explanation or some conversation or discussion around the balance sheet. The author doesn't talk about the balance sheet at all, or assets or liabilities or debt that these companies may have. And I did some analysis using the website, and I wanted to keep that market cap threshold at over $10 billion. And some of the companies that were recommended through this magic formula were some popular names, right? So we're talking Dick's Sporting Goods, we're talking eBay, we're talking Best Buy, Cisco, Pfizer, and even Qualcomm, to name a few. And these are indeed profitable companies, and each of their businesses are very, very specific to their niche, and they've got significant competitive advantage, but they're not so great in terms of their balance sheet. Oftentimes, I would find that these companies are holding on to too much debt or too much liability, and for those reasons, I wouldn't necessarily consider being a shareholder, because that's something that's important to me, and I would like to know before investing in these companies long term. Either way, I guess this is an interesting investing approach which can only be tested once we're really applying this in the real world with a real capital. Because it's one thing to backtest a strategy which outperformed the market in the past in theory, and completely different when applied in real life. So let me know your thoughts down in the comment section below, and are you excited to actually try out this strategy for yourself? Let me know in the comment section down below. As always, happy investing. I'll see you all in the next video.